Welcome to The Explainer. Today, we are going to tackle the question every single trader asks themselves probably multiple times a day. Is the price too high or is it too low? And we're going to look at a really powerful visual tool that's designed to give you a clear answer.
All right, let's just jump right in. Every trader, every investor, they're constantly asking this question. We're all looking for that little edge, right? That visual cue on a chart that screams, hey, this price has gone too far, stretched to its limit, and maybe, just maybe, it's about to snap back. Well, the tool we're going to break down today, it's all about giving you that clear visual answer. What it does is create this dynamic channel. You can think of it as a normal range for the price. This way, you can see instantly when it starts to wander too far away from its average. So what is this thing exactly? And how in the world does it draw these boundaries on our charts? Okay, so at its heart, the envelope indicator is actually, well, it's pretty simple. It starts with a central moving average. You can kind of think of this as the fair value line, and then it just draws two parallel bands around it. The key here is that these bands are set at a fixed percentage away from that middle line, creating the zone that, well, usually contains the price. And I love this analogy. It makes so much sense. Just think of the price as a river. The moving average, that's the main current, right down the middle. And those upper and lower bands, those are the river banks. Most of the time, the price just flows happily between those banks. But it's when that river starts to rise and threatens to overflow its banks, that's when we get a signal. That's when things get interesting.
So how are these bands, these riverbanks, actually built? What's the math behind it? Honestly, you might be surprised at just how simple it is.
Okay, so it all kicks off with a simple moving average. First, you pick a period, let's say 20 days. Then you choose a percentage, how far away you want the bands to be. We'll use 2% for this example. The upper band, it's just the average plus 2% of its value. And the lower band, you guessed it, the average minus 2%. Seriously, that's the whole calculation. And here's the formula, laid out plain and simple. You've got your midpoint, which is just the moving average. Then the upper and lower bands are just that fixed percentage, added or subtracted. That's really the defining feature of the envelope indicator, that simple fixed percentage approach. Now, this is absolutely crucial. This tool is not a one-size-fits-all thing. You get to control the two main levers here, the moving average period and that deviation percentage. If you use a shorter period, the bands are going to hug the price really closely and you'll get a lot more signals. If you use a bigger deviation, the channel gets wider and you'll get fewer signals, but they might be more significant. The whole game is about tailoring these settings to whatever asset you're looking at and, of course, your own trading style. All right, so we've got our bands drawn on the chart. Now what? What are these lines actually trying to tell us? Let's dive into how to actually read the signals they're spitting out. Okay, so the most common way to read this is all about mean reversion. It's a simple idea. When the price shoots up and touches that upper band, the thinking is that the asset is probably overbought. It's gotten too expensive, too fast, and it's due for a pullback, a return to the average. And, the opposite is true for the lower band. Price hits that, and it might just be oversold. Okay, and this is where it gets really interesting. This is a huge insight into how markets work. You have the exact same signal, the price hitting one of the bands, but traders use it in two completely opposite ways. A mean reversion trader sees the price hit the top band and they sell, right? They're betting on a reversal, a return to normal. But then you have the trend follower. They see the price break through that same band and they buy because they're betting that a powerful new trend is just getting started. So, who's right? The mean reversion person or the trend follower? Well, the answer is, it totally depends on the market. Mean reversion is your best friend in a sideways ranging market, where the price is just bouncing predictably between the bands like a pinball. But trend following, that's what you want in a strong, clear trend, where a breakout is a sign that the move has some serious power behind it. It's all about context. Context is everything. Of course, the envelope indicator isn't the only game in town. It doesn't exist in a vacuum. So how does it stack up against that other famous band indicator, Bollinger Bands? Let's take a look. The biggest difference comes down to one thing, how they measure how far the band should be from the middle line. Envelopes, as we've seen, use a fixed percentage that you set. Bollinger Bands are different. They're adaptive. They use standard deviation, which is a fancy way of saying they automatically get wider when the market goes crazy and then get tighter when things calm down. With envelopes, you're the one who has to make those adjustments manually by tweaking the percentage. All right, so let's get real about the pros and cons here. On the plus side, it's super easy to understand, it's visual, and it's pretty versatile. It gives you some really clear levels for managing risk. But yeah, there are definitely downsides. Since it's based on a moving average, it's always going to be a little bit behind the action. It's a lagging indicator. And it can for sure give you false signals if you haven't set it up right. And in a super strong trend, you might just see the price glue itself to one of the bands for ages, which kind of makes the whole thing less useful. So, okay, we know the good, we know the bad. The big question is, how can you actually use this tool effectively in your own analysis? Okay, rule number 1, do not use this thing by itself, ever. You always want to confirm its signals with another tool, something like the RSI or just looking at volume. Rule number 2, you have to adjust your settings. You can't just slap the same parameters on everything. What works for a boring old stock is not going to work for a wild crypto asset. And finally, if you're playing the breakout game, be patient. Wait for a full candle to close outside that band before you jump in. That confirmation is key.
So when you boil it all down, the envelope indicator is a really versatile visual guide. Its main job, its whole purpose, is to draw a normal price range on your chart. And by doing that, it highlights any time the price steps out of line, giving you a really clear place to start your analysis.
And that brings us to the final big picture question. Since this whole thing is built using past data, is it really a guide for the future? Is it predicting where the price will go? Or is it just a really well-drawn map of where the price has already been? I think the answer, like with any tool in trading, lies in how you blend its insights with your own read on the market. And that, right there, is the real challenge, isn't it?